What if I told you Wall Street's top analysts have pinpointed 3 stocks they're calling strong buy right now? Forget the hype. These are companies with real fundamentals and huge growth potential. Today we'll break down what these companies do and why the smartest minds in finance are so bullish. We're diving into 3 sectors: real estate finance, precision oncology, and gene regulation biotech. First, a real estate finance giant with a fortress-like portfolio. Next, a pioneer in precision oncology, changing how we fight cancer. And finally, a biotech innovator unlocking gene regulation to tackle tough diseases. These aren't random picks. They're backed by serious analyst conviction and could be game changers for your portfolio. Let's get into it. Our first strong buy is Rithm Capital, ticker RITM, a powerhouse in real estate finance that's quietly building a fortress of stability and growth in a sector known for its ups and downs. While many investors chase the latest tech trends or high-flying growth stocks, Rithm is quietly compounding value in the background, leveraging its unique position in the real estate finance world. What sets Rithm apart is its diversified business model. Unlike traditional real estate investment trusts that focus on just one area, Rithm operates across mortgage servicing, mortgage origination, single-family rentals, and asset management. This multi-pronged approach means the company isn't overly reliant on any single revenue stream, giving it a built-in resilience that's rare in the industry. This diversification acts as a powerful shield against market volatility. When one segment faces headwinds, say, a slowdown in mortgage originations due to rising rates, another, like mortgage servicing, often benefits. It's a natural hedge, smoothing out earnings and reducing the risk of big swings that can rattle investors. At the heart of Rithm's stability is its massive portfolio of mortgage servicing rights, or MSRs. These assets generate stable, recurring cash flow, especially when interest rates are high and homeowners are less likely to refinance. MSRs are like the golden goose of real estate finance, providing a steady stream of income that helps anchor the business, even in turbulent times. But Rithm doesn't stop there. The company is also a major player in mortgage origination, helping thousands of families secure new homes every year. By capturing a significant share of the origination market, Rithm not only diversifies its revenue, but also positions itself to benefit when the housing market rebounds or when interest rates eventually decline. On top of that, Rithm owns and manages thousands of single-family rental homes across the country. This segment provides another reliable income stream, as demand for rental housing remains strong, especially among millennials and families seeking flexibility. The rental portfolio is a key pillar of Rithm's long-term growth strategy, offering both cash flow and asset appreciation. Analysts consistently praise Rithm for its track record of strong, consistent returns, and its proactive, forward-thinking management team. The company has demonstrated an ability to adapt to changing market conditions, making smart moves that keep it ahead of the curve, and delivering value to shareholders year after year. Despite all these strengths, Rithm's stock remains undervalued compared to its peers. The current share price doesn't reflect the company's true earnings power or the quality of its assets. For savvy investors, this disconnect represents a rare opportunity to buy a high-quality business at a bargain price. One of the most attractive features for income-focused investors is RITM's generous, well-covered dividend. The company pays out a substantial yield, supported by its stable cash flows. This means you're not just waiting for the stock price to catch up, you're getting paid to wait, with a steady stream of income that can help offset market volatility. Behind the scenes, Rithm's management team is made up of industry veterans with decades of experience. They've steered the company through multiple market cycles, making strategic decisions like investing heavily in MSRs when others were pulling back, and expanding the rental portfolio at just the right time. Their disciplined approach and deep industry knowledge are major assets for shareholders. Rithm's resilience is no accident. Its business segments are carefully balanced to complement each other, creating a smoother earnings profile than most competitors. This balance means that even when one area faces challenges, the others can pick up the slack, helping to ensure steady performance through all phases of the economic cycle. The company is also pursuing strategic acquisitions and shifting more focus toward asset management, which is a higher margin, less cyclical business. These moves are setting the stage for long-term growth, expanding Rithm's capabilities and opening up new revenue streams that can drive shareholder value for years to come. As the housing market begins to normalize after recent volatility, Rithm is well positioned to benefit from a rebound in mortgage origination. Meanwhile, its asset management arm continues to expand, both domestically and internationally, tapping into new markets and opportunities that many competitors simply can't reach. Wall Street analysts are taking notice, with many projecting 20–30% upside for the stock based on detailed financial models and forward-looking estimates. These projections are grounded in Rhythm's strong fundamentals, diversified business mix, and the company's ability to generate cash flow in a variety of market environments. Yet the market continues to misprice Rhythm as just another mortgage rat, overlooking its evolution into a diversified asset manager with a unique, multi-segment model. This misunderstanding creates a compelling opportunity for investors who can see beyond the label and recognize the true value beneath the surface. Of course, no investment is without risk. The main concern for Rhythm is a severe downturn in the housing market, which could pressure some of its business lines. However, the company's diversification and its large MSR portfolio act as strong buffers, helping to protect against the worst-case scenarios and providing a level of safety that many competitors lack. Looking ahead, Rhythm is also expanding its footprint globally, exploring new markets and forming partnerships that could unlock even more growth. This international push adds another layer of diversification and potential upside, making the company's future even brighter. Rhythm Capital is operating at meaningful scale, with a market capitalization of about $6.25 billion. The stock is trading at a price-to-earnings ratio of roughly 7.73, backed by earnings per share of about $1.46. In 2024, the company generated approximately $3 billion in revenue and delivered net income of around $835 million, which speaks to solid profitability relative to its size. In summary, Rhythm Capital stands out as a leader in real estate finance, offering a rare combination of stable cash flows, significant growth potential, and a price that's hard to beat. For investors seeking both income and appreciation, it's a compelling package that's hard to ignore. That's why Rhythm Capital earns our strong buy rating. It's an ideal choice for long-term investors who want to build wealth steadily, enjoy reliable income, and benefit from the upside as the market recognizes the company's true value. Next, let's move from the world of real estate to the front lines of cancer treatment, where innovation and hope are changing lives every day. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our second strong buy is Nuvalent, ticker NUVL, a clinical stage biotech at the forefront of precision oncology. In a world where cancer remains one of the most complex and devastating diseases, Nuvalent is pioneering a new era of hope. This company is not just another player in the biotech space. It's a trailblazer, leveraging cutting-edge science to develop therapies that could redefine how we treat cancer at its roots. Nuvalent develops targeted cancer therapies, focusing on genetic mutations that drive cancer growth. By zeroing in on the specific genetic errors that cause cells to multiply uncontrollably, Nuvalent's scientists are able to design drugs that are far more precise than traditional chemotherapy or radiation. This approach means that instead of attacking all rapidly dividing cells, their therapies home in on the actual drivers of the disease. Their approach is to design drugs that attack cancer's root cause, sparing healthy cells, and reducing side effects. This is a game changer for patients, as it means fewer of the harsh side effects that have long been associated with cancer treatment. Imagine a future where cancer therapy is not only more effective, but also gentler on the body. Nuvalent is working to make that a reality. Nuvalent targets kinases, proteins involved in cancer cell growth, especially in lung cancers with specific genetic alterations. Kinases act like molecular switches, and when they malfunction due to mutations, they can drive relentless tumor growth. By developing inhibitors that specifically block these rogue kinases, Nuvalent is aiming to shut down cancer at its source, particularly in patients who have limited options. Their lead programs address patients who don't respond to existing therapies or develop resistance. For many cancer patients, the initial treatment may work, but over time, the cancer adapts and becomes resistant. Nuvalent's drugs are designed to overcome these resistance mechanisms, offering new hope to those who have exhausted other options. Early clinical trial data is highly promising, showing best-in-class potential and strong efficacy, even against brain metastases. In fact, some patients who had run out of alternatives have seen their tumors shrink or stabilize, including those with cancer that has spread to the brain. A notoriously difficult challenge in oncology, their drugs are engineered to cross the blood-brain barrier, a huge advantage in treating cancers that spread to the brain. Most cancer drugs can't reach the brain due to this natural defense, but Nuvalent's molecules are specifically designed to penetrate this barrier, opening up new possibilities for patients with advanced disease. Nuvalent's pipeline is diversified, with multiple candidates targeting different cancer drivers. This means the company isn't betting everything on a single drug. Instead, it's building a robust portfolio that could address a range of cancers and genetic mutations. Each candidate is carefully selected based on deep scientific understanding and unmet medical need. The company's development pipeline is advancing rapidly, with several programs already in clinical trials and more in preclinical stages. This steady progress demonstrates both scientific rigor and a commitment to bringing new therapies to patients as quickly as possible. The management team has a proven track record in biotech, inspiring analyst confidence. Many of Nuvalent's leaders have successfully brought drugs from the lab to the market before, and their expertise is a major asset as the company navigates the complex world of drug development and regulatory approval. Analysts see a massive opportunity. If even one drug becomes standard of care, it's a multi-billion-dollar market. The potential for Nuvalent to capture a significant share of the oncology market is enormous, especially as precision medicine becomes the new standard in cancer care. The company is well-funded with enough cash to advance its pipeline without diluting shareholders. This financial strength allows Nuvalent to focus on science and innovation, rather than worrying about raising money in the short term. It's a rare position for a clinical-stage biotech, and it gives the company a strategic edge. Strategic partnerships could bring in more funding and validate their technology. Collaborations with larger pharmaceutical companies or research institutions not only provide resources, but also serve as a vote of confidence in Nuvalent's approach and potential. Risks remain. Clinical trials can fail, and competition is fierce. But the risk-reward profile is compelling. Drug development is never a sure thing, and setbacks are always possible. However, the potential upside for patients and investors alike is significant, especially given the company's scientific foundation and early results. Analyst price targets are 5,100% above current levels, reflecting the huge potential. As more data emerges and the company hits key milestones, there's a strong possibility that Nuvalent's valuation could rise dramatically. Nuvalent's science sets it apart: deep kinase biology expertise and next-generation drug design. Their research team is constantly pushing the boundaries of what's possible, using advanced computational tools and molecular modeling to create drugs that are both highly effective and precisely targeted. Nuvalent sits at a market capitalization of roughly $7.37 billion, but it is still in a loss-per-share phase with earnings per share of negative $5.33. Even so, the figures provided show net income of about $260.75 million, a data point investors will want to reconcile with the per-share loss to understand what's driving the gap between headline earnings per share and bottom-line profitability. For investors, it's a chance to get in early on a company that could transform cancer treatment. With a strong scientific foundation, a diversified pipeline, and a clear vision for the future, Nuvalent stands out as a biotech innovator with the potential to make a real difference in the fight against cancer. Now, let's look at a biotech innovator tackling disease at the genetic control level. Our third strong buy is 𝗤𝗏 Therapeutics, ticker FHTX, a true pioneer in the world of gene regulation. While many biotech companies focus on targeting specific genes or proteins, 𝗤𝗏 is taking a bold, foundational approach. They're aiming to control the entire gene regulation system itself. This is a company that's not just developing new drugs, they're working to rewrite the rules of how our cells function at the most fundamental level. 𝗤𝗏's platform is built around the chromatin regulatory system, which acts as the master control for gene expression. Chromatin is the complex of DNA and proteins that determines which genes are turned on or off in every cell. By understanding and manipulating the system, 𝗤𝗏 is unlocking entirely new ways to treat diseases that have long been considered intractable. By fixing this master control system, 𝗤𝗏 aims to address the root causes of diseases like cancer and neurological disorders, rather than just treating symptoms. This approach could potentially lead to more durable, long-lasting treatments, and even cures, for some of the most challenging conditions in medicine. Their lead program is focused on synovial sarcoma, a rare and aggressive cancer that primarily affects young adults and has very limited treatment options. Early clinical trial results have shown durable responses, giving hope to patients who previously had few alternatives. This is a significant milestone not just for 𝗤𝗏 but for the entire field of oncology. But 𝗤𝗏's ambitions don't stop there. Their pipeline includes multiple candidates targeting a range of cancers, including both rare and more common types. This demonstrates the broad potential of their platform, which could be applied to many different diseases where gene regulation goes awry. A major partnership with pharmaceutical giant Eli Lilly brought in hundreds of millions in funding and served as a powerful validation of 𝗤𝗏's science. This collaboration not only provides financial resources, but also access to Lilly's deep expertise in drug development and commercialization, accelerating Foghorn's progress. Despite these advances, analysts see a significant disconnect between Foghorn's current valuation and its long-term potential. The market seems to be underestimating the impact that successful gene regulation therapies could have, not just for Foghorn, but for the entire biotech sector. Even if only the lead program in synovial sarcoma succeeds, it could justify a much higher stock price. But with a robust pipeline and the possibility of expanding into other indications, the upside could be even greater. Investors are watching closely as each new data release and clinical milestone could serve as a catalyst for the stock. Of course, the risks are high. Early-stage biotech is always uncertain, and setbacks are common. Clinical trials can fail, and regulatory hurdles are significant, but the innovation here is undeniable, and the potential rewards for success are enormous, both for patients and for investors willing to take the risk. Foghorn's management team is a key asset. It includes world-class scientists with deep expertise in gene regulation, as well as experienced biotech leaders who have successfully brought new therapies to market before. Their vision and execution are critical to navigating the complex path from discovery to approved medicine. As Foghorn's programs advance and more data emerges, the company is increasingly seen as a potential acquisition target for larger pharmaceutical companies. Big Pharma is always on the lookout for breakthrough science, and Foghorn's unique approach could make it a highly attractive buyout candidate. If Foghorn's approach proves successful, the applications could extend far beyond cancer. The same gene regulation technology could be used to tackle neurological disorders, rare genetic diseases, and potentially even conditions we haven't yet imagined. This is the kind of platform that could redefine what's possible in medicine. Analyst price targets often imply a doubling or even tripling from current levels, reflecting the multiple catalysts ahead. These include upcoming clinical trial results, potential new partnerships, and regulatory milestones that could rapidly change the company's outlook. Investing in FHTX is more than just a bet on a single drug, it's a bet on a paradigm shift in medicine. By learning to control the gene traffic that determines cell fate, 𝗗𝗜𝗦𝗖𝗢𝗓, Foghorn is aiming to treat disease at its very source, rather than just managing symptoms. Foghorn Therapeutics has a stated market capitalization of about $291.8 billion. The company posted earnings per share of -$1.14, with revenue of roughly $22.6 million in 2024, and a net loss of about $86.6 million, highlighting a business that is still spending heavily relative to current revenue as it works to scale. For investors with a high risk tolerance and a long-term perspective, Foghorn Therapeutics represents a unique opportunity to participate in the next wave of biotech innovation. As always, do your own research and consider your risk profile, but keep an eye on FHTX as this story continues to unfold. There you have it, 3 strong buy stocks, each with a unique story and major analyst backing. Rhythm Capital offers stability and income, Nuvalent is pioneering precision oncology, and Foghorn is rewriting drug discovery. Analysts see a gap between current prices and long-term value in all 3. Remember, strong buy isn't a guarantee. Do your own research and understand the risks. Which stock do you think has the most long-term potential? Let us know in the comments. For exclusive tips and analysis, join the Stocks Galore Patreon. Link in the description. Like, comment, and subscribe for more investing insights. Thanks for watching. See you in the next one.